All right. Hi, everyone. I'm Paul, an analyst at Finimize. Welcome back to our summit. I'm here with two very special guests. I have Tony Raza, who is head of multi-asset investing at UOB, and Andras Vig, a multi-asset strategist with Invesco. We're going to be discussing alternatives to the SP 500. But before we do that, a little bit of housekeeping. I'm sure you're all familiar with by now. Introduce yourselves in the chat box. Tell us where you're tuning in from. Please also answer the poll that you should see appearing on your screens. This is going to be a 30-minute discussion followed by 15 minutes of audience Q&A. And do make sure you ask a question because we're giving away a free Finimize subscription for the best question in the box on today's session. Okay, let's dive in. Tony, Andras, how are you guys doing today?
Good, thanks.
Good, thank you.
Super, well, it's great to have you with us. I thought a kind of fun place to start would be, and we're going to come back to the topic of this session, which is alternatives to S&P 500, but maybe to begin with, just to set the scene, if we, both of you give us a kind of high level view or a summary or a wrap of 2022, maybe a tour around the world or asset classes, looking at the winners and the losers for this year so far. Tony, maybe you can kick us off.
Okay, yeah. So especially from the multi-asset perspective, this is a year where there really weren't any winners. It was a matter of degree in the losers. Everything from equities and fixed income, gold and Bitcoin and commodities. Maybe commodities did okay in like February, but since then they've been struggling too. So it was really a tough year. And I think the additional perspective that I think a lot of investors probably don't even appreciate, but I guess as like a multi-asset manager, I see quite clearly is that I think, most investors I speak to probably are a little bit equity biased when they look at markets. And for the most part, everyone knows equities didn't have a great year, but it's not necessarily as bad as like, really bad years like 2008 or anything like that. But if you're managing a multi-asset fund, actually, this is a really bad year. And in particular, what happens is if you're managing money for clients that are fairly conservative and trying to be lower risk, what happens is the way those portfolios are designed, they're doing like extraordinarily bad. And we've gone back in history, like over the last 100 years, and we would argue that this may be the worst year ever. And it's somewhat strange in the sense, I'll look out my window, everyone has jobs, all the restaurants are full. It doesn't feel like this should be worse than the Great Depression, and it shouldn't be worse than, stagflation of the 70s. But the way it all sort of came together, it's been really just bad on a really broad basis, and combined portfolios, and especially those who are trying to keep it safe, are just struggling harder than ever.
Thanks, Tony. I'll come back to you on a couple of those points, but Andras, from your perspective, have you anything to add to those comments?
Yeah, I agree with Tony. It's been a tough year, and apart from, I guess, energy, commodities, and cash, especially US dollar and UK sterling cash, you would have struggled to find any positive returns, especially in US dollar terms. The strength in the dollar was really putting pressure on most asset classes. In local currency returns, there were a few highlights within asset classes like UK equities, Japanese real estate, or Chinese sovereign debt or corporate debt. But I agree, when we're talking about the death of 60-40, it just shows you how tough a year we've had, and a lot of that comes down to quite a unique combination of pressures on markets like supply chain disruptions, commodity shock, and also the Federal Reserve and most central banks raising rates into a global economic slowdown, and that doesn't normally happen when central banks raise rates. It normally happens when the global economy is doing well.
Cool, thank you. Tony, curious about your comment, and you've gone back over decades, and this seems to be the worst year ever for multi-asset investing, or at least 60-40, and we've heard a lot about the death of 60-40. other than that putting you in an uncomfortable position, what are you saying to your clients who are asking you the difficult questions about multi-asset investing and, you know, structuring portfolios around the traditional 60-40 balance?
Yeah, so I'd say if I mean, I think there's a lot of discussion on how this has happened and all that, and I give the stories as I said, but I do think there are some silver linings here, and that I do like to leave clients with, and I think people are looking for a little bit of hope here. And so the first thing I take away is that things like a lot of our forward-looking returns for the, especially even as soon as the next year, are looking better. And so, like, firstly, then it'd be in fixed income, right? Yields are just much more attractive now than we've seen in a decade, and this is a good thing going forward. And we can design portfolios now that should actually be pretty solid for, you know, the coming years. You know, I would go through the details. I mean, I'd say even just pretty straightforward, high quality corporate bonds, I can get yields of like 5.5%, in some cases up to 6%. We've been grabbing some of these, and so this is a good thing. And then I guess the other part that I think is a bit of a silver lining is just more like a part of our near-term outlook is it is our view that these inflationary problems may not go away right away, but we're pretty convinced they're peaking, and that the trend for the next 6 months at least is going to be helpful. And therefore that would be the risk on why, like, these fixed income opportunities wouldn't come through. And therefore we really kind of think we see a lot of sort of win-win situations in these yields. If there's a recession, then they probably do very well, but even without a recession, there's just good yields to cream. So it's been a bad year, but there are some silver linings, and we try to highlight those things.
Super, thanks, Tony. Maybe that's a nice segue into a slightly more forward-looking view, Andras, for 2023. Do you kind of agree with Tony's view that the setup is looking more attractive for multi-asset investing into next year? What are you thinking about? What are you communicating with clients as you look forward over the next 12 months or into the medium term?
Our base case is based on the market regime changing, and at the moment we are very much in a market contraction regime where most asset classes are struggling. The traditionally defensive asset classes have now started to outperform in the last quarter or so. If we looking at sovereign debt or defensive equity sectors, or even sort of more defensive regions like for example the US, and it will probably be, with a bad football analogy, a year of two halves. So we'll still stay in this contraction regime for some of next year. But eventually we'll reach a point where a market recovery will start and risk assets will start outperforming. In that sense, we're trying to keep our foot in both camps, so have a bit of defensive exposure to be prepared for continuing market volatility, but also start kind of allocating into riskier assets. Especially some of the more defensive risky assets in fixed income, for example, and perhaps real estate, where we have a bit of a yield pickup. As Tony mentioned, yields are much more attractive, and that's exactly what we're seeing now as well. The good thing about such a bad year is that valuations are now lower, yields are now higher, so you've got at least a bit of hope and potential looking forward.
Okay, super, thank you. Let's pivot a little bit and think slightly longer term. If the last, or the 2010s, or the last decade would be characterized as the decade of the SP 500, where, you know, annualized returns were north of 10%, and really just buying and holding an SP 500 tracker you couldn't lose. Do you think that is unlikely to be the case for the next 10 years? And if it isn't, which region or asset class do you think are going to, you know, is going to reign for the next 10 years, are going to be the leading light? Because I think a lot of our investors hear a lot that, you know, the last 10 years have been great. It's unlikely that will repeat going forward. So how do you answer that question? What's your views around that? Maybe Andras, you can go with that one.
So in terms of the medium to longer term returns, what we're seeing is that there's a divergence, or was sorry, a convergence in forward-looking asset returns. So there's a cash is looking quite attractive at the moment with higher interest rates, but also in terms of within risk assets, as you mentioned, the S&P 500 ruled the last decade or so. The previous decade was more of an EM outperformance a decade, and we have and we think with valuations more attractive in relative terms, we would prefer, our preferred risky or cyclical asset would be in emerging markets. And we've done a little bit of work looking into a bit more detail into which regions emerging markets within emerging markets look the most attractive, and in terms of what we're seeing, perhaps Latin America, certain parts of Africa look quite promising, especially when we're looking at the very long term. So maybe not just the next decade or so, but multiple decades.
Yeah, thanks. This is probably a nice segue into a discussion more broadly around emerging markets. But I was trying to go back and I was looking at the performance of the various indices this morning and yesterday, and I was struggling to remember a period of time where emerging markets would have outperformed the S&P 500. So I think the decades of the noughties, EM did really well, certainly up till kind of 2008. But do you have a sense of, like, over the very long term, the comparative returns between the emerging markets index, like the MSCI emerging markets index, versus developed markets, and how they would compare? We know that the S&P led the way in the last 10 years, but for investors who may be lucky enough to have a 20, 30, 40-year time horizon, any sense of those sort of comparative returns?
If it's staying with me, it's as they say, it's really difficult to make these predictions on a 10-year basis. The good thing about it, in 10 years nobody will remember what I've said. But being a bit more serious, the S&P 500 is a really strong index. So and the last decade wasn't necessarily because other regions underperformed. It was because the S&P 500 had such a strong return profile, and that was partly connected to the falling interest rate environment and kind of this low growth, low inflation kind of global economic environment that I think we are unlikely to see that the return to that would not necessarily be a top of my probability list, especially in the kind of the next few years. We'll still be focusing on inflation. In a sense, within markets, we're always fighting the last war. In the last decade or so, we were always worried about banks because we had the global financial crisis. And I think looking forward in the next 10 years or so, we will probably be more worried about inflation. And in that kind of environment, what was the strength of the S&P 500, as in exposure to high growing technology stocks and these mega cap growth stocks, will probably not be the best, or will not probably provide the best returns.
Okay, thanks, Andras. Maybe we can delve into some of the specifics of the emerging markets, particular emerging markets that you mentioned he doesn't work on. But before we do that, Tony, are you broadly in agreement with Andras's view that perhaps going forward, investors will get better returns out of the emerging markets that almost been forgotten about over the last 10 years because, as I said, it's just been easy to buy the S&P 500 and forget about everything else? Is that broadly your opinion? And then we can maybe pick apart some specific investment markets.
Yeah, and I think just to recap it the way I always think it, and I think it's similar to what Andras and you were highlighting. But so for the S&P 500, one, I mean, we really respect just the power of the earnings power of those U.S. corporates. It may not be the strongest growth economy in the world, but it's really efficient earnings driven companies that are doing great for the industry. But if our concern is the fact that I think, like Andres was highlighting, that so much of that market cap has been driven by these mega cap tech stocks, and really when we break it down, one of the main differences on why you're getting so much outperformance of the S&P 500 is that they're the ones with all these FANG stocks and these mega cap techs, and the rest of the world really doesn't have them. And if you normalize for that, then the U.S. performance starts to look, actually it still would outperform a bit, but it looks a lot closer to what the rest of the world is doing. And therefore, I'm not sure we can count on the U.S. market as being driven by that, which makes up like 25% of its market cap anymore. So I do think we should be aware that I think to your original question, there have been periods of history where other parts of the world have outperformed the U.S. and in the 90s and the 2000s up to 2008. There were really attractive returns to be had in the world. And it's been a long time since we've had that. And this underperformance by the emerging markets and Asia have left us with some really good valuations that I do think set up an opportunity for the future. And exactly, I think timing it is complicated, but I have a lot of confidence it's there structurally.
Super, thank you. Maybe let's double click a little bit on, I mean, emerging markets is hugely broad. Okay, there's Latin America, there's Asia, there's even frontier markets. But from your guys' perspective, double click on emerging markets, which areas of the world are looking the most attractive right now? And again, I come back to that medium to long term view rather than trading, because as you rightly point out, Tony, it's extremely difficult to time some of these markets that tend to be really volatile. There's lots of macroeconomic concerns. There's the dollar to think about. There's, various things that you're never going to time right. So with a longer term perspective, where do you think looks really attractive now for our investors?
Who should go?
Tony, you can go ahead with that one. We'll flip over.
Okay, so I was sort of prepared. I think you were going to ask about emerging markets, and so I guess I wanted to start off with my great perspective on emerging markets, and it goes back to so I myself, I'm American, but I've been in Asia since the 90s, and so when I started investing in Asia, I had two mentors, and so one highlighted that if you really want to understand emerging markets and Asia in particular, you really need to understand the US dollar. Once you figured out what's happening in the US dollar, you can figure out emerging markets. And then I had another mentor who said, actually, it's all about China. Figure out what's happening in China, and I can tell you what's going to happen to the rest of the emerging markets. And for the most part, they're both, key drivers of emerging markets. And if you did your analysis over history, those would be the sort of like, the highest correlated factors to driving what's happening. What I find interesting right now, and I guess to your question of, where should we look and how do we see things? So what stands out to me in a year like this is the US dollar has been really strong and China has been really weak. So my old models would say this should have been the worst of all years for emerging markets, but it wasn't really. I mean, I think actually emerging markets may be slightly underperformed, but it really wasn't so bad. And actually for many of these countries, many of the South Asia countries were all outperforming global markets. And it stands out to me because other times where we've had this amount of US dollar strength, what you would be talking about is contagion and fragile countries and the amount of stress these countries usually are facing, but they didn't this year. There was like a couple cases, Sri Lanka and a couple places, but they're really very specific events tied to the way they manage their own country. Broadly, it didn't create any massive problems. And likewise, this has been such a weak year for China. You would have thought this would have really could have brought down the rest of Asia, but it really didn't. And so what I like about what I'm seeing is I'm seeing these countries stand on their own a bit better. I see more sort of branded companies that are holding up their value and not just depending on global flows anymore. And so and then I guess, I mean, also, just in terms of just near-term views, we're pretty convinced China's reopening, and I think that's going to be one of the biggest economic drivers in the next year. I think it's going to be good for Asia broadly, but North Asia in particular. And additionally, I think I mentioned it before, but the valuations are really coming from a starting point that are very attractive. I mean, I think a lot of these stories go in the same direction, but I guess our focus right now is a little bit more Asia biased. I'm in Asia, so I mean, maybe that's a geographic bias, but I think the story is adding up well, and I like how well it held up last year, and that's giving me encourage that if things are actually getting better. And I guess the last point that we think about in Asia is that, you know, interest rates in the US have gone up to 4 or 5%, and for a developed economy that's, you know, has lower structural growth, that's a pretty big headwind, and that's something to worry about. But in Asia, you know, 5% interest rates is what we've dealt with for, you know, 3 decades. That's nearly nothing that extraordinary. There's enough structural growth here to believe that it should continue. So, you know, my thing is, I don't mean to sound like overly rosy that, oh, this is going to be a great year for Asia, but I as far as like a sort of emerging trend, I like the way things are setting up, and I think that's one of the things that we're looking at.
Really fascinating. Thank you. I think also, just to add that, one of the, you know, we in the developed world are dealing with a lot of the problems, as you point out, interest rates, but also inflation, right? Inflation has always been a problem that investors have never been able to get their heads around when investing in emerging markets. But, well, look what's happened to inflation in the US or in Europe. And so almost to a degree, the playing field has been leveled somewhat. And that, I think, is what you're saying is maybe helps explain some of the strength. But before we move on to András's view, if I could just ask just a couple of the things that you mentioned, which might be worth a little bit of clarification. So the dollar in particular, why has that been a major issue or a thorn in the side for emerging markets as an asset class historically? If you could just unpack that a little bit for our investors.
Sorry, was that for me?
Yes, Tony, sorry, for you, just
yeah.
to follow on from your comment about your mentors telling you that you need to figure out the dollar, you need to figure out China.
Right.
Why historically has a strong dollar been a problem for emerging markets?
Yes. So, and just to be clear to all investors, I mean, the trend I would specifically mean is when the dollar is very strong, that's bad for emerging markets. When the dollar is very weak, that's usually good for emerging markets. And I think there's a few reasons for it. So one, it just highlights investment flows around the world. When the US dollar is weak, it kind of means that people are attracted to invest in things around the world, and you're seeing all those other currencies go up, and that's kind of partly driven by fund flows. There's another effect that I think is also part of this, and I guess, you know, these are economic theories that maybe can be debated, but usually a lot of the US dollar weakness comes when the US economy is very strong and they're buying lots of goods from the rest of the world. And in that process, they're spending all their money. It could be driving down the dollar, but they're sort of like exporting dollars around the world. And that creates an environment that sort of creates markets that thrive everywhere when you have those types of periods. But you know, I think a lot of the market strategists I talk to take it as a rule of thumb: when the dollar's strong, avoid emerging markets when it's weak. And nobody necessarily is completely, you know, sure of exactly their reasons, but I think it goes along those lines.
Super, thank you, Tony. And András, you mentioned in the answer to the previous question that you've been doing quite a lot of work on the various areas, geographies within the global emerging markets in general. Maybe you could highlight for us, you know, where you're focused for next year and beyond, and what you're talking to clients about, etc. Thanks.
In terms of emerging markets, we always highlight as well that the dollar is key, and this year the dollar has been exceptionally strong and strengthening. But in a sense, this kind of economic environment is tailor-made for emerging markets. And Tony mentioned as well that they've been fighting these kinds of things for decades, and we are less familiar because the last time inflation was this high was 40-50 years ago in developed markets. We have lost the tools to fight, and if you remember, some of the major emerging market central banks started tightening well before the Fed. They were raising rates at a quite significant clip. For example, in Brazil, where 6 months before the Federal Reserve kind of pivoted into this rapidly monetary tightening environment, and so what I think is that they have better tools, and therefore the investing environment is much more tailor-made for some of these emerging market economies, and in the longer term, especially, valuations are key, and the relative of the valuations compared to some of the developed market especially within equities, are much more attractive. And what we've done is we've looked at how these valuations compare to historical norms going back 10, 20 years, as much history as we could find, and also compare these valuations to the emerging markets benchmark, and where we found these kind of the cheapest or the most attractive regions were as I mentioned before, Latin America, for example, despite all the political uncertainty that we have there, and in the longer term, even if GDP growth is not necessarily does not necessarily have a high correlation to asset returns, but there is it is necessary. It's not sufficient, but it's necessary. And where we see the best longer term potential is some of the Asian economies like Indonesia or India, where you've got attractive valuations as well as good growth potential. And also, if African capital markets start to become more sophisticated, that deepening capital market environment would be the probably a good place to look at.
Yeah, thank you, Andreas. I'm really fascinated about one of the points that you made, which I think will make for an interesting follow-up question. I've never really invested in emerging markets specifically, but have been a global investor in previous lives, and always struggled with the concept of faster GDP growth should get better equity returns. You've just basically highlighted one key factor, I think, is that they don't necessarily correlate. Do you have anything to elaborate around that? Because I think it's a really interesting concept, because a lot of investors just automatically go to GDP growth as the first port of call as to why an equity market should do better. And really, there isn't much correlation at all. But like you say, it's necessary because companies need sales growth, right? And that's where they get it from. So it's just something I've personally wrestled with. So I'd love to hear your perspective on that point.
Well, but from that point of view, starting valuations are very important, and some of the and also corporates need to be able to grow at least the same pace as the economy, or even outperform it. And that's what happened in the US in the last decade or so, that these mega caps became mega caps because they outperformed the US economy and became big global corporate entities. And so I think that's key, that which companies have the potential to expand, and if we're becoming more regional in terms of the global economy, then local or regional populations will become more important, and demography, if demography is destiny, as they say, then the demographic advantage is in the emerging markets, and they also have the potential for deepening capital markets and increasing the sophistication of these capital markets. Some of the most successful emerging markets were the ones where that happened. The final point I would make is that emerging markets is a bit of a strange entity to talk about, because there are so many different economies that are grouped together, and from big commodity producers to ones where the local economy is kind of more important. So So it's just I think it's important to look a bit deeper and maybe do a lot of research into what's happening in those local markets and which corporates are best placed to take advantage of that.
Yeah, I think it's really interesting. If I can sort of maybe summarize or paraphrase a little bit, it's true that GDP growth is necessary, but in the States, for example, corporate profits as a percentage of GDP have been growing. So effectively, American companies have been outgrowing their home country GDP. Part of that is because, you know, international economies have been boosting their profits, but you get this sort of bigger growth in the share of the pie, which sort of decouples them from GDP. But maybe because of the sheer size of these companies and the sheer profitability that they've managed to produce, that potentially could be coming to an end, which would play into the hands of, you know, companies outside of the States. I guess the same question to you, Tony. Would you have a view on that particular concept of GDP decoupling or delinking, and maybe, you know, the next 10 years looks better from that perspective for emerging markets companies?
I mean, yeah. So I think both of you highlighting. I mean, it's counterintuitive, but GDP has no correlation to equity market returns, and it's not only, you know, the stronger GDP in emerging markets versus the U.S., but even if you were looking at the U.S. market, the times with like, oh, even just the last decade, GDP was among its most sluggish and subpar for an entire decade, but the markets had great performance. And as far as what the way I would just summarize it, I think what just drive markets are. It's more corporate efficiency, ability to have, you know, high return on equity, and that has a lot to do with sort of just the management of the companies. And I'd say just the other part is just what really drive multi-year returns are valuations. And I think to the original whole point, I think of this conversation, and you're bringing up the questions of alternatives to the S&P 500, is that's legitimate because the S&P 500 is the most expensive index in the world. And when we map out what we think of as our long-term capital market assumptions, or we're trying to we have models to drive what we think like 10-year returns would be, we actually would have the US actually a little bit lower than most markets because of that valuation. It also gets some benefit from being a very efficient earning market, but the valuations is one of the big red flags for the US market.
Great. I think that's very clear. Thank you both. I'm going to start to just throw a few questions at you from the audience. This one, I think, is a really interesting one. Maybe you can talk to the discussions that you're having with your clients. And it sort of goes back to the point that we discussed earlier about maybe lower potential returns going forward, and the option for investors between getting exposure via index funds or very diversified passive investing versus potentially being slightly more active to try and get, you know, maybe slightly higher returns or even a bit more concentrated. So when you think across the equity or even other asset classes for that matter, how do you speak to clients about the recommended proportion of their money they have in index funds versus, you know, maybe single stocks or you know, maybe more concentrated specialist ETFs or something like that? Tony, why don't you take that one?
Okay. So there's a couple parts I would break that down. So the first thing that jumped out in the question was the lower expected, you know, longer term returns. So one thing I would just quickly counter on that is actually that's actually not what we're finding. Our models, you know, are heavily influenced by valuations and both within, you know, fixed income and equities, and because valuations have gotten better over the course of this year and yields of fixed income have gotten a lot higher, mostly as you know, we build out our asset class projections, we're getting much better outlook right now than we were, say, a year ago. But I think still the heart of that question was really, well, should I just try to take advantage of that through more passive structures or active structures? And I think we're all aware that the passive structures have been very efficient and good ways to get exposure to a lot of this, and I think that's good. But I do think what stands out in the market now, and I guess it's our particular bias, is that we're seeing more diffusion between returns of the better companies and the weaker companies. I think there have been times, especially in these years of QE, where just sort of markets were all just being driven by a lot of liquidity. And in times like now it's actually the strong companies stand out more than the weak companies. And we're seeing that difference in returns. And so therefore, even in our own money as we're deploying it, we're deploying more active now than usual. But I guess my broad answer would be passive is very efficient, and I wouldn't really discourage it. But I would highlight that if you're down on active after this last decade, I can understand that. But I think things actually are changing at the heart of it, and then these higher interest rates are forcing us to need to pick winners versus losers a little bit more than they were in the last decade.
Great, thanks, Tony. And then a question for you, Andras. How do you think about the risk? We've talked about returns quite a lot, but how do you think about the risks that investors face if they're investing outside of the traditional S&P 500, which is often pitched as a lower risk approach to investing, which is absolutely true, of course, because it offers a diversified way to get exposure to equities. So maybe when you're thinking about coming outside of the S&P 500, how do you, and this is you can go with which any direction you wish with this question, maybe it's thinking about emerging markets, maybe thinking about small caps. How do you broadly assess the risks of coming away from something that perhaps people know and love and have been comfortable with investing in for some time?
I think as you mentioned, the S&P 500 is a kind of nicely diversified index. There are other indices which are pretty similar, but the smaller the market, the more concentrated these indices tend to be, and especially in some of the European markets, European indices, or indeed emerging markets indices, there is that concentration risk where you're exposed to a certain sector or an economy with a certain specialization. For example, if we're talking about the UK, the FTSE 100 index has a very big weighting in the energy sector and healthcare, which is why it did quite well in local currency terms in this past year or so. So I think that's important to keep in mind, that diversification will may be reduced in especially smaller markets, and also what may happen, and this tends to happen when interest rates rise, is that corporate risk becomes higher, especially in economies or in corporate kind of environments where you have large indebtedness, and we've done a bit of work on that, and some of the probably the emerging market corporate debt levels. There are some economies where we find that uncomfortable. In a lower interest rate environment, it matters less. But we've had this regime change where I think these two, so I would say concentration risk and indebtedness would be two of the main concerns I would have outside the US.
Thanks, Andras. One question that I hear quite a lot is, well, if you think about broad asset classes as equities, bonds, or alternatives, then maybe the conclusion is, and Tony, you disagreed with this, but maybe the conclusion is that, well, certainly we hear a lot that returns are going to be lower. One way to kind of transcend all that would be to think about themes. Is thematic investing something that you guys bring into your thought processes when you're constructing portfolios? And if it is, which major themes, global megatrends, however you want to describe them, do you think are important for investors to be aware of for, again, the medium to long term? So Tony, do you want to kick us off? Thank you.
Sure, yeah. We're spending a lot of time focusing our investments and I think designing funds for. So various themes are one around demographics, which is there's global trends in general, but also, us being based in Asia, there's a big story there. It's, especially, where the way markets are driven and wealth is driven, it tends to be by middle class. And essentially all the growth in the middle class in the next decade are essentially going to be coming from emerging markets in general, and a big chunk of that is going to be Asia first, and then it's going to be followed by Africa and other parts of the world. But so for the coming decade, that whole demographic thing is we're focused on, and all the sub-industries related to that. I think the other part that I'm sure is covered in your panels, but we're spending a lot of time just with the theme around climate change and all the sub-level of investing opportunities that are coming out of that. We're spending a lot of time, one, just to make sure we're positioned on the right side of it, but also just to make sure aware of all the changes and the opportunities. So I think those are a couple of the biggest that we focus on.
Great, thank you. And Andreas, anything to add, just broad agreement, or is any other themes that you guys are thinking about right now?
I would also highlight as probably the two most important themes that we're thinking about. And one of them is the energy transition, which has come to the fore quite rapidly, and more rapidly than we would have expected, with a commodity shock this year, but also a technological change. And we may be going through another industrial revolution, and the good thing is that once we come out on the other side, then we'll have higher productivity within the economy. Unfortunately, we're still in the adjustment phase when productivity is quite low. There's a lot of turbulence in markets and maybe in the broader economic and political world as well. So I think these two, so technological change and the energy transition, are those that I would highlight.
Fantastic, thank you. And then maybe one last one for you, Andreas. We're getting a question here about Africa. In fact, I've seen questions being asked about Africa across a number of our sessions that we've hosted over the last couple of days. Maybe frontier markets are back on people's agenda. Perhaps it's because returns out of China haven't been so great. I'm not sure. Have you guys looked into any frontier markets? Andreas, this is for you. Do you have any views as to what the future holds for places like Africa and the growth of the capital markets there?
Yeah, we did publish on Africa, looking at all the countries and looking at how how their economies are shaping up and how their capital markets look like, and also demographically, Africa is where the growth is. And that's what will remain to be the case for the next decade, where we had big demographic growth, especially in Asia, that's kind of tailing off or has reversed, and so that's where we would look at them. Maybe at the moment it's difficult to see how that could become a next big thing, especially since it's at the moment quite difficult to invest in African markets, but we think that it will become more open and easier to access in the future.
Okay, we are pretty much out of time, gentlemen. So from me, thank you very much. I thought that was a really fascinating discussion. I've learned a lot about investing outside of the SP 500. I hope our audience has as well. So thank you both for joining us. For the audience, stay tuned for the last virtual session of the summit, entitled "Is This the End of Crypto?" with the one and only Anthony Pompliano. You're not going to want to miss that. We've also got more merchandise and subscriptions to give away. So thank you everybody once again, and we will see you in 15 minutes for the closing session. Thank you.
Thank you.